Hello traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. Now, did you know that price gaps in the market can create some of the best trading opportunities? Now, if you've ever seen a stock or currency pair open far away from its previous close, then you've witnessed a gap. And well, of course, if you're looking at this screen, then you're going to see something like that. And well, you can see what happened here. This is what we call a gap. But how do you actually trade these gaps effectively? Now, in this video, we're just going to be breaking down gap fill trading strategies. Okay, why gaps happen, how to trade them, and the best ways to avoid false signals. Whether you are a day trader or swing trader, mastering gap trading can give you a major edge. All right, so stay till the end because I'll share a key trick that can help you filter out false gaps and improve your accuracy. And before we jump in, don't forget to hit that like button and subscribe if you are serious about leveling up your trading skills. All right, now let's just start with the basics. What is a gap? Now, a gap occurs when the price of an asset opens significantly higher or lower. In this case, it was lower, significantly lower than its previous closing price, leaving a price void on the chart. Now, this usually happens due to factors like overnight news or earnings reports that shift market sentiment, or economic data releases that create sudden price movements, or institutional buying or selling that triggers big imbalances. Now, here's the key. Gaps don't always continue in the direction of the open. In fact, many gaps get filled, meaning price returns to the previous level. This is where the gap filling trading strategy comes in. Not all gaps are the same, okay? And understanding their type can help you determine whether to trade the fill or follow the trend. Now, here are the main types. We actually have the common gaps, okay? Common gaps are the ones that frequently occur with no major catalyst. So anytime you find a gap on your chart and it happens that there was no catalyst, maybe there was no economic event, there was no significant news or fundamental factor that caused that shift in price, then that could likely be a common gap. Okay, they often get filled quickly, making them ideal for gap fill trades. Okay, then breakaway gaps is another type of gaps, right? These ones happen at the start of a strong trend. So breakaway gaps, you will likely find them when a strong trend is about to start. So they just break past key levels. Now, instead of filling, price often continues in the breakout direction. So whenever you notice a gap happen in a strong trend, perhaps maybe you notice, okay, I can't really find one right now, an example right now. Yeah, I don't think I can exactly find an example right now. This might actually be a common gap because I don't exactly remember if there was a significant event. Anyways, I might have to check the, perhaps economic calendar just to confirm if there was any events that took place around this time. But this is the one that I can confirm that there was likely, a shift in sentiment, right? I think was it over the weekend or something like that? But I can remember that there was something actually that caused this, all right? But now I'm just checking to see if we had breakaway gaps. Any example? That one usually happen when a strong trend when it's about to start, okay? But if you find such, maybe around a support and then just saw price just jumped up, and then continued upwards, that's likely a breakaway gap. Or maybe around the resistance and price just jumped down, and continue, that's likely a breakaway gap. Now, we also have runaway gaps, right? These appear mid-trend. Runaway gaps appear mid-trend, signaling momentum continuation, okay? So in that case, price rarely fills these gaps. So whenever you find a gap that happens in the middle of the trend, signaling continuation of the momentum. You might not always get filled. The gaps might not always get filled. Okay. Then we have exhaustion gaps. Exhaustion gaps are the ones that occur near the end of a trend. Those ones occur near the end of a trend, and it's often, it gets filled quickly. Spotting this can lead to high probability reversal trade. Now let's talk about how to actually trade gaps effectively. Okay, using this as a case study. Now the first strategy is the classic gap fill trade. So you have to identify a common gap. You have to identify a common gap where price opens away from the previous close. Then you look for signs of weakness after the open, e.g., rejection candles or wicks, rejection candles or wicks, right? Then you enter when price starts moving back toward the previous close. Then you can just set your stop loss beyond the high or low of the gap. Then your take profit can be the gap fill level, right? The gap fill level. Then the second strategy is the breakaway confirmation trade. If you identify a breakaway gap that pushes price out of a range, you wait for a pullback and retest of the breakout level. All right. Then you enter if the price holds the breakout zone and resumes momentum. Okay. Then for your stop loss, you can just place your stop loss below the breakout level and then take a profit, around resistance zones or perhaps Fibonacci extensions. All right. Then the third strategy is the volume confirmation trick. High volume equals to strong breakout, likely not filling. Okay. Then low volume is equals to weak move, high chance of gap fill. All right. So let's just add the volume indicators. So whenever you notice a high volume, which represents a strong breakout, there is a chance that the gap might not get filled. Might. All right. Now let's just see. See, we had a gap around here. This is probably an exhaustion gap, I think, because you can see this occurred at the end of the trend. This occurred at the end of this trend. Yeah, this occurred at the end of this trend. So this is likely an exhaustion gap. Then we can see that there was actually, well, not exactly a spike in volume. There was low volume. Can you see around here when the gap happened? And you can see that the gap got filled. Can you see that? Can you see that the gap got filled? So if you had entered here, you can see the gap got filled. Then in this particular example, which might be because this seems to be a consolidation phase, and it might actually be a common gap, or although there might be an overnight effect, but anyways, you can see that the gap got filled, right? So basically, when you notice uh when you notice any reversal candlestick pattern forming after the gap has occurred, it might be a chance that the gap is about to get filled. You can then take advantage of the opportunity and enter a trade. Okay. Now let's talk about one of the biggest mistakes traders make, which is trading false gaps. Here's how to avoid them. Always check pre-market or overnight news. Was there a real catalyst? It's important to check that. Then you look at higher time frames. Is the gap happening near strong support or resistance? Then confirm with volume. If there's no strong participation, the gap is more likely to get filled. So by following these steps, you can filter out weak setups and focus on high probability gap trades. So do you trade gaps? What's your favorite gap trading strategy? Let me know in the comments below. And if this video helped you, hit that like button. It really supports the channel. Also, make sure to subscribe and turn on notifications so you never miss a powerful trading strategy like this one. In the meantime, thank you for watching, and I hope to see you in the next video.